Well, good afternoon, Patelco Credit Union members, and welcome to Uncharted Waters, Navigating Stock Market Volatility in a Coronavirus World. My name is Carolyn Wilson. I am the Director of Investments and Insurance at Patelco Financial Solutions. We are very excited to bring this important topic to our members. It's very timely. We live in a very, very different world right now, between a pandemic, a presidential election, protests, quarantines, even the good news of a vaccine coming on board. This market has given us a wild ride in 2020. We are here to help you navigate through these times. Before we get started, let's go over a few housekeeping items. All participants will be in listen-only mode. Today's presentation will last about 30 minutes. You are encouraged to type in your questions in the Q&A section as you think of them at any time during the presentation. After the presentation, we will begin the Q&A session. Our partner for this webinar is Franklin Templeton. We've had a very close relationship for Franklin Templeton for decades. They have been generous enough to bring us two speakers today, Andrew Prupis and JB Walker. Both Andrew and JB are vice presidents and senior advisor consultants. Together, they have over 45 years of experience in the investment world, 30 of those years solely with Franklin Templeton. We are thrilled to be able to have the knowledge and experience they bring to the table. At this time, I would like to turn it over to Andrew to start the presentation. Andrew?
Thanks, Carolyn. I appreciate the introduction and thank you for having us today. More importantly, though, thank you for all of you guys joining on the call. We appreciate it. I think you'll find today's discussion to be informative and timely, given what's happening in the world today. So, as Carolyn said, my name is Andrew Prupis, Vice President, Senior Advisor Consultant. I've had the proud privilege of representing Franklin for the last 15 years. And as Carolyn also said, we have the pleasure of my colleague, JB Walker, joining us as well, who also has been with the firm for over 17 years. So I assume most of you are working from home today, as I am as well. So I've instructed our nanny to give our 4-year-old twins literally whatever they desire, so they won't come screaming in my office over the next hour. So let's hope that doesn't happen today. Just a quick side note before we jump into the agenda. If you're not familiar with Franklin Templeton, we're the 6th largest asset management firm in the industry, with over 1.4 trillion in assets. Our headquarters is in San Mateo, California, just off the 101, we're one of the few that's located in the West Coast. And then lastly, we started back in 1948, so over a 70-year track record of investing, and we're considered one of the most trusted asset management firms in the business. So let's jump into the agenda for today's discussion. I'm gonna kick off the presentation with a few intro slides discussing the market from a historical perspective, and then I'll turn it over to JB, who will discuss investing from a behavioral finance standpoint and what's going on in our heads during these challenging times. And then I'll come back in to close things up and discuss living with the market volatility, because I think we're going to be with it for quite some time. So with that, let's jump into the presentation. For those of you that have been investing in the stock market over the last 10 years, here's what it would have looked like. We've been pretty fortunate to experience a bull market. This slide shows you the growth of the S&P 500 over the last 10 years. Remember, the S&P 500 are the largest traded US companies, so this tends to be a pretty good indication of how the stock market has done over the years. So if you hear myself or JB reference the stock market, we're probably referring to the S&P 500. So the average annual return of the S&P 500 over the last 10 years, which includes the current crisis, has been 13.75%, pretty good. However, for those of you that maybe haven't been investing for the last several years, or maybe recently have been added to the market, this may be your first experience of a negative stock market. So it's not surprising that investors' emotions are running high during these periods of time. So if we look back at the events and how the recent shocks have impacted the market, I think we all know by now the last 9 months, the world's become a very different place, right? The virus has brought the world to a standpoint, pushed hospital systems to the brink, and dragged the global economy into recession. So if we kind of look back at the time horizon on 12/31/2019, COVID was first reported in Wuhan, China. And then in March 11th, the World Health Organization declared COVID-19 a pandemic. And that's really when the market started to turn. March 23rd, the Federal Reserve announced new measures to support the economy. April 16th, Trump issues guidelines for states to reopen their economy. May 15th, the House passed a $3 trillion corona relief package. June 8th, officials declared the US in a recession. July 27th, the vaccine enters phase 3 testing. And then September 4th, that's when the markets again begin to decline with concerns around the COVID-19 crisis, doubts about a vaccine, and uncertainty around the US stimulus package. And here we are today, 63 million people now have been affected by the virus and 1.4 million killed. So in the end, it's still too early to tell when we will finally recover from this. However, there's some very important news on the horizon. As of today, we have 5 large-scale phase 3 clinical trials that are in progress, all with result rates above 90%, which is fantastic. And secondly, despite what your political view is, the elections seem to be finalized. And this is all very positive news for the stock market. One of the things we do know for sure is that the stock market hates uncertainty. So it looks like we have a little bit more direction going into 2021, which really is going to help the markets. However, despite some of that news, we do know that volatility can cause investors to act on their emotions, and that lessons learned from the past can help navigate these uncharted waters. So the first point, let's look at the market from a historical standpoint. This chart shows going back to 1970, so a 50-year time frame. It shows both bear markets as well as bull markets. And in this illustration, a bear market is defined as a 15% decline from the peak. And I think what you can concur from this slide is that bull markets have lasted much, much longer compared to bear markets. And the average gain during a bull market was much larger than the average loss during a bear market. And I think this slide right here will really sum it up. Bull markets on average grow 403%. They tend to last for just over 7 years. And then bear markets on average fall just about 42% and just over 12 months in length. Now, unfortunately, market declines, it's just part of investing. And if we look at some of these declines in the past, take our first example, market corrections of 5% or more have historically happened once every 10 months. The last one was in August of 2019. Market corrections of 10% have historically happened once every 2 years. The last one is December of 2018. Market corrections of 15% or more historically happen once every 4 years. The last one was also in December of 2018. And then here we are earlier this year where we saw a 20% correction in the market, which most people consider a bear market. And those tend to happen every 8 years or so. But I think it's critical and very important that during every single one of these pullbacks, the market has always bounced back, not only to where it was before, but also bounced back to make all-time highs. Now let's look at the markets from past outbreaks. And when we do that, the markets have rebounded pretty nicely. Think about SARS back in 2003. Think about the swine flu in 2009. Think about Ebola back in July of 2014. And then Zika, January 2016. And then, of course, here we are today with COVID-19 in December of 2020. And look, there's nothing like the coronavirus and definitely different than the past outbreaks. And we don't know how it's all going to play out. But you can compare it to historical epidemics to kind of put things in perspective. So with that, I'm going to go over and turn it over to JB, who has the fun part of the presentation, talking about what's going on in our heads during these challenging times. So JB, take it away.
Thank you, Andrew, and welcome aboard, everybody. Thank you so much for tuning in. And this is actually the scary part of the presentation where a recovering CPA gets to talk to you about investor psychology. So I hope you'll enjoy it. We are going to talk a little bit about investor behavior, investor psychology, and that typically revolves around decision making. Because decisions can be really challenging, why don't we all warm up with an easy one? Pretend that after this call, you get up and you open the refrigerator, and on the left, you see what appears to be a healthful salad. And on the right, you see what appears to be at least triple and maybe quadruple chocolate cake. Ask yourself, which one do you pick? Now, normally this is the source of a lot of banter and fun when Andrew and I give this presentation live. And I would propose that it's not so important what you pick. What's important and what we want to contemplate here is what's going on in our head as we make the decision. Our brains have been developing for a long time, and certainly since we've been walking upright. And there's a couple of distinct components. A very prominent one is the frontal cortex. It's often deemed the logic center. The frontal cortex in our example is likely to tally up calories. It's likely to determine that that salad is better for diet and heart health. Very likely it would lead us to the salad. Now there's another important part of the brain, the amygdala, the reflexive brain, often associated with fight or flight or extreme emotion. That amygdala remembers just how delicious triple or quadruple chocolate cake is. It might even remember an experience, maybe a first date where that was the dessert. The amygdala would likely lead you to the cake, and that might lead us to believe that the amygdala is bad. Not necessarily. Imagine being the cave person on the right, and you can see the little amygdala there. Imagine being that cave person and encountering the saber-toothed tiger on the left. Now, I'm not going to speak for anybody on the call, but personally, I wouldn't want my frontal cortex to waste time processing what 9-inch fangs, 4-inch claws from a 500 or 600 pound cat could do. I'd want to run like hell. So the amygdala works. However, when it becomes overstimulated in the investment process and the decision-making associated therewith, that's where you can have undesirable outcomes. That's what we're going to talk about. And we did not invent these or discover these at Franklin Templeton. We did give them a name. In another presentation, they are called the 6 barriers to investment success. And what we're going to cover here in the interest of time are 2 of them. The first one is called anchor bias. This is where we focus too heavily on limited information or a single piece of information when we make decisions or formulate our expectations. Now, here's an example of anchor bias. Imagine that you have to fly in a couple of weeks, and instead of going to an airline's website, and God forbid, nobody goes to a travel agency anymore, you go to one of those clearing platforms like Travelocity or Expedia, maybe Orbitz. You've had experience with the platform getting deals on tickets. You go in and your flight is priced at $400. Now, out of laziness or out of the belief that you can do better on your price if you wait, you wait. Now your travel date is approaching. You go back on the site knowing you have to buy your ticket. You go in and lo and behold, the price is $500. How do you feel? Not so good. It's more expensive. Let's reverse that. Same set of circumstances. You got to travel in a couple weeks. You go to your platform, price $600. Out of apathy, out of laziness, or the belief that you can do better, you wait until the last moment to book your ticket. You go to your platform and you get the same exact outcome, $500 for the ticket. How do you feel? You feel great. You saved $100. In both instances, you had the exact same outcome, but it all depends on what anchor you set for yourself. Was it 400 or was it 600? That's anchor bias. Now, at Franklin Templeton, every year, we conduct and commission investor sentiment surveys. What you're looking at here is the results of our 2020 survey. The question was, what is the average annual return that you expect over the next 5 years out of the stock market, the S&P 500? And not surprisingly, the number is pretty high. 10% is above what we've seen over the last few years, but in the wake of some pretty strong performance, it's understandable. Now, here's something that our consultants and we did with our survey. We started asking the question differently. Before anticipating or asking for the expected return, we presented the respondents with a hypothetical set of year-by-year stock market returns, including a year where the market was up 20%. Ask yourself, what do you think the expectation became after the introduction of that 20% anchor? And you're probably spot on. It went up and it went way up all the way to 20%. Now, I'm not going to speak for the financial advisors with whom you work, but 20% year over year from the stock market is not a reasonable expectation. In fact, here on the next page, I'm going to show you what typically financial advisors will use for an average return out of the market when they construct a long-term plan. 8% average annual is pretty reasonable if you look at the market over the long term. And let's look at an example. What if you invest $10,000 at 8% for 30 years? We can see that it grows on a nice smooth basis to just over 100 grand. Ask yourself if you would buy this investment. If you would, you'd have to line up behind me because I'd be the first guy in line. This investment doesn't exist. Here's one that does, and it comes with good news and bad news. This is nothing more than putting 10,000 in the passive stock market, the S&P 500. The good news is obvious. It grows to over $172,000. The bad news, it doesn't grow in a straight line. It comes with the ups and downs that the market brings over years, over many, many years. Anchor bias is so critical. If you focus on the uptrends in the market, think about becoming a new investor during one of the uptrends and anchoring, expecting those types of returns and that velocity, only to be disappointed when the market goes through a normal gyration. And despite being on track for a long-term goal, you might exit the market at the wrong time. Anchor bias is critical. The second bias we're going to address is called loss aversion. The pain that we associate with a loss is much more intense than the reward we experience from a gain. Researchers tell us it's about twice as powerful. Said differently, as Homo sapiens, we are risk averse. And that's okay, but it's important to understand it and to manage the risk. In our example here, I'm going to reference some videos that are from the old Jimmy Kimmel show. One of the funnest things he did, he told his viewers to basically on November 1 in the morning, tell the kids they ate all their Halloween candy from trick or treats the night before, record it, get the reaction, and send it into the studio. Here's some examples of how we learn the pain of loss early.
I ate all your Halloween candy last night.
There's no more candy left in your pumpkin. It's just trash. Oh no. Dad must have eaten all your candy when you went to sleep.
Don't you guys think you ate enough candy last night?
No, I only had like one bite of candy. Are you serious? And you want to rest? Oh, good for you. Now you're gonna have probably get a bellyache. You see how much I had? I went to a lot of houses.
I know. I ate it all. It tasted so good, especially the peanut butter cups.
You sneaky mom!
All right, so you all decide, is that child abuse? I've got an 18-year-old daughter named Kate, and I still remember the last time she went trick-or-treating with her friend Isabel. They filled up pillowcases with candy, and like any good parent, I dumped it all on the table and kind of scoured through it to make sure everything was okay. There was one full-size Butterfinger, and I ended up eating it. I thought she was going to call Child Protective Services. So I understand this video. What's the problem with our fear, our innate fear, and our loss aversion? Fear can drive investors into cash or a money market. If you go back to the dot-com era bust back in the early 2000s through the latter part of 2002, almost $500 billion flowed out of the market and into money market and cash assets. During the global financial crisis, 07, 08, early 09, it was almost $1 trillion. While we don't have the final numbers yet, it appears that with the COVID volatility we experienced this year, it was about $1 trillion. Now, we're not here to tell you that any portfolio should not have liquidity. Every portfolio needs some, but as a long-term investment, money market does not cut it. And to go in and out of it represents a timing decision that is usually a bad decision. Andrew's going to talk about that later. If we look at money market accounts, here are the yields over about the last 20 years, and you can see on a good news or a good note, they're positive. They range from the upper threes down to 0 to slightly positive today. And I understand the psychology here. If I go into this money market account, at least I'm not losing money. Is that correct? The answer is, of course it's not. After factoring in inflation, the inflation adjusted return or yield is actually negative. And keep in mind that over the last decade or so, inflation's been pretty benign. Cash assets, money markets do nothing to protect purchasing power, which is so critical for long-term plans. The last point on this slide is, don't forget, as and when we begin to earn legitimate money market yields, somebody else is probably going to come calling to take some of our return away. And that's Uncle Sam, and in the case of Californians, Uncle Gavin. We can't forget about taxes. Those eat away and have a corrosive impact on our net return. So we talked about anchor bias, we talked about loss aversion. Maybe somewhere down the road we'll meet again and talk about the other behavioral biases. I'm going to turn it back over to Andrew to talk about how we cope with market volatility. Thank you.
Thanks, JB. So we talked a little bit about the market from a historical perspective. We talked a little bit about bull markets and bear markets. JB did a fantastic job discussing how we think during these challenging times. Now let's transition into the final section, which is living with market volatility. And there's a few methods when it comes to living with market volatilities that I think can help. And first, and arguably the most important concept of investing is to stay calm and keep a long-term perspective. Why do we tell people to stay calm and look at a long-term perspective? It's this slide right here. Suppose you had $10,000 and you put it into the market in 1970 and you held it to today. Think about it. There would have been several events over the course of history that would have caused short-term volatility. Here's just a few. You could probably put up another 5 or 10. Energy crisis back in the 70s, Black Monday, 1987, the tech boom and burst in 2000, global financial crisis, and then COVID-19. Well, $10,000 invested in the market today would be worth $1.5 million. That's an average annual return of 10.6%. So again, taking the long term is so important. So the next approach to staying calm is to tune out the noise. This chart goes back to the 1970s as well up into today. And basically what it's showing you is if you invested in the stock market for one day, which is under what they say daily, from 1970 to today, you would have a 54% chance of making money and a 46% chance of losing money. Not very good odds. If you jump out to the 1 year and you invested for 1 year for that 50-year time frame, you had an 80% chance of making money and a 20% chance of losing money. Much better odds. But look at the far right, the 10-year period. If you had invested for 10 years from 1970 to today, you had a 91% chance of making money and only a 9% chance of losing money. Another strategy to deal with market volatility is diversification. It can help reduce volatility and provide a much smoother ride. This chart looks complicated, but it's rather simple, and we use it quite often in our industry to kind of show diversification and why diversification is so important. And we often, we call it the jelly bean chart because it has different colors and it kind of looks like a jelly bean. So this chart goes back to 2005. You can see the years on the top, and each of those boxes are different, or what we call different asset classes. So within the stock market, there's different asset classes like large cap growth, value, bonds, small cap, international, emerging market. And each one of those asset classes are ranked from the best performing to the worst performing for that specific year. So for example, take 2017. In 2017, on the top right, you'll see the best performing asset class for that year were emerging markets. They were up 37%. So maybe you thought about it and said, you know what, I'm going to put all my money in emerging markets the following year. Well, in 2018, as you can see on the bottom, emerging markets were the worst performing. They were down about 14%. So I guess the point of this is that winners rotate. There's no pattern, and you don't want to put all your money in one asset class. Here's another similar example to that last slide. Let's say you decided that you want to put all your money in the best performing asset class for the last 20 years. So let's say you're going to chase the winners, kind of like 2017 in the emerging market. So every year you put $10,000 in the best performing asset class. Your return would have been 200 to 438,000. So that's about a 6.9% return. Next, let's say you decided I want to put all my money in the losers. I want to try to be a value investor. And so every year, 10,000 you put in the worst performing asset classes over 20 years. Your 200,000 grows to 416. That's about a 6.5% return. Or let's say you worked with a professional advisor and he or she built you a customized portfolio that was properly diversified. That's what we call an asset allocation. Your 200,000 grows to 469,000. That's over a 7.5% return. That's a big difference in outperformance over several years. And lastly, remember your investment plan when markets become volatile, and review that plan, when your emotions are running high. This chart shows you why it's important to stay the course by staying investing. In this chart, the blue bar represents the largest decline, a peak, which is the height, to the trough, which is the low that occurred each year. So go down to the very bottom, you'll see all the years, and pick out 2003, for example. It's right there in the middle. In 2003, you can see at one point, the overall stock market, which is in blue, in 2003, the stock market was down 14%. However, by the end of the year, which is in green, the market had recovered and the market actually closed up 29%. So just because we're having a negative year doesn't mean things can't quickly recover and we can have a positive year by year end. Also remember, while this volatility can be challenging, it also represents some pretty good buying opportunities as well. Speaking of buying opportunities, let's not forget about dollar cost averaging. Simply put, dollar cost averaging is committing a fixed amount of money at regular intervals to an investment. So you buy more shares when prices are low and fewer shares when prices are high. So over time, your average cost per share may be less than the average price per share. And maybe one of the most important themes is trying not to jump in and out of the market, because it can be costly, or we also call this market timing. This is a 20-year period. So if you stayed fully invested in the market for the last 20 years, your return would have been about 6.3%. Not bad. Remember, this includes 2008, 2009 financial crisis, includes the COVID meltdown. However, let's see what happens if you missed some of the best days in the market. For example, let's say you missed just the 10 best days in the market. Your return goes from 6.37% down to 3.46. It's cut in half by just missing the best 10 days in the market. If you had missed the 20 best days in the market, your return goes from 6.3 down to 0.78. And if you missed the 30 best days in the market, over the last 20 years, your return goes from 6.3 to a negative 2.46. So again, it's absolutely critical that we stay invested. And one of my favorite lines is, it's time in the market, not timing the market. Again, it's time in the market, not timing the market. Let's end with my favorite slide of the presentation. I think it's great. This chart shows you over the last 20 years, what are the 20 worst single trading days, which is on the left in blue, followed by the 20 single best trading days, which is on the right in green. And in many cases, the best trading day follows immediately after the worst trading day, which just shows you how difficult it is to try to attempt to time the market. So for example, let's look on the very left on the bottom left-hand side, you'll see November 12th, all the way in the bottom, November 12th, 2008. For that day, the stock market was down over 5%. So maybe you called your advisor and you said, I want to get out of the market. I'm nervous. They tell you to stay the course. Why? Well, literally the next day, if you follow that blue dotted line up to November 13th of 2008, literally the next day, the stock market is up 6.9%. It had one of its best trading days ever. So in the end, market timing is almost impossible. Work with a professional that can build you a customized strategy based on your goals and risk tolerances. So just to kind of maybe sum things up from our discussion today, history has shown us that market reacts to shocks in the short term, but they tend to reward long-term investors. Number 2, emotions affect decision-making abilities in times of market volatility. And lastly, 3 strategies to help live with the market volatility. They are stay calm, be properly diversified, and of course, remember your investment strategy. So with that, thank you all for the time today. I'll now turn over to Carolyn to open up for questions.
Yes, very good. In fact, perfectly timed, about 30 minutes. We have a good amount of questions. Some of them have already been answered, but I think that everybody would benefit from hearing from our hosts, from our speakers. The first one is from Patricia, and she says, based on your charts, why not just stay in the S&P rather than other investments? So JB or Andrew, would you like to take that?
I could take that one. I would probably just show the diversification slide with the jelly bean chart. And although the S&P 500 is a good investment, as you can see, there's times where if you look outside the US over the last 20 years, the best performing stock market has not been the S&P. It's not been the United States. In fact, it wasn't even in the top 3 over the last 20 years. So what I would tell you is that if you look at the world market capitalization, that's where all the stocks are in the entire world. A lot of them are outside the US. And so we're in much more of a global world than we've ever been before. So just like you wouldn't put all your eggs in one asset class, I wouldn't put all your eggs in just the S&P 500.
Andrew, this is JB. Another point that I would add to that, the S&P 500 or any other passive index, can be a very low cost way to get involved with the market. The one issue that we see these days, remember that these passive indices are capitalization weighted. That means the bigger the company, the bigger the influence. And right now, if you look at the performance in the S&P 500, it's literally been driven by 5 or 6 stocks. That's 5 or 6 stocks out of 500. So re-emphasizing Andrew's point, it's nice when those things perform well and propel the index, but when it changes, you absolutely want to be diversified. So we think it's a good part of a long-term strategy, but diversification is the key.
Okay. We have another one from Ray. Why use a professional? Are they lowering your return because of cost, such as 1% cost, thus rate of return of 7 through professional, effectively 6, which I could do using index? How would you answer that? Why use a professional?
I'll take that one, or at least start with it, and Andrew can contribute to it. We believed, dating back to the 1940s when we founded, Franklin Templeton, and I like to say when they founded it, I wasn't around then, thankfully. I'm not quite that old. But ultimately, we believe that counseled money does better over the long term. There's a lot of things that a financial professional can bring. Among those, one would be financial planning. I mean, it might seem rudimentary and simple, but there are lots of nuances to the financial planning process, and these goals, objectives, and circumstances can change over time, and it's great to have somebody involved with you in that process. The other thing deals a little bit with the topic I took today, and that's the investor psychology. I guess there are examples of people out there that are going to steadfastly stick to an allocation. They're going to believe their beliefs, they're going to doubt their doubts, and they're going to stick with their investments. But we found over the decades that counseled money does better. Frequently, people need coaching, and a lot of times people need explanation to get proper diversification into suitable asset classes designed to help them in meeting their long-term goals. So I wouldn't say that a financial planner or consultant is mandatory. There are people out there that can and do effectively do it themselves. We find that the vast majority don't. So we definitely believe in the value of advice. There's also a little sidebar note. There are different groups out there that emphasize low cost, buy direct, buy passive indices. One of those companies is Vanguard. Vanguard devotes a lot of time and attention to describing and sharing some ideas about the value of financial professionals. So we feel pretty confident that that profession is here to stay. Good question, though.
Good, very good question. A lot of these are, you may have answered them, but they're still very good questions. Given the volatility of the market, do you recommend holding some of your retirement portfolio in cash? If so, what percentage? I speak as someone already retired. So although I do take some risk with my retirement funds, not as much as before when I was in my career and earning and contributing to retirement funds.
I can take that one. I think, first of all, I think everybody should have a certain amount of cash in their overall allocation for emergencies. And I don't know exactly their risk tolerance and them personally, but I think it's professional to have at least 6 to 12 months of cash on the sidelines for unexpected costs that may come up. And for that, I think the rest should be invested. Again, I can't tell you exactly what it should be invested in based on not knowing your risk tolerance, but I think everybody should have a certain amount of liquid cash on the sidelines, and probably less to the extent than they had maybe 10 years ago because of where interest rates are and what slide that JB Walker showed. And that is if your money is in money markets or CDs, and you are including inflation, it's eroding your purchasing power. So probably less than you expect, but at least have something to make sure you have money for any kind of emergencies.
Okay, good answer. Now, I've had this question come up several times, and whether or not people can have copies of the presentation. Yes, we are recording it, and we are going to be posting it to our website. So we'll give you more information about that later, actually in a follow-up email as well. Could the companies engaged in clinical trials for a COVID vaccine be good companies to invest in by purchasing their stock? You
want that one, Andrew, or you want me to take it?
Yeah, let me just give you my 2 cents, and then JB, you can fill in.
Great.
I think the problem, first of all, a lot of those companies, yes, I think they're good quality companies and they'll be around for a long time. But what the problem is that the market has already anticipated that those companies are going to have a vaccine. So unfortunately, they probably already run up quite a bit, knowing that we already kind of know what the companies are that are going to create the vaccine. So they've kind of already been priced to a higher extent. So I think maybe longer term, they're maybe a good idea, but I don't know, JB, maybe you could help me.
Yeah, one of the oldest adages in our industry, you probably heard this, at least some people on the call, it's called buy on the rumor, sell on the news. So to Andrew's point, a lot of that news is it's priced into the stocks. I do have financial advisors and clients that are going to have a component of the portfolio where they're I don't want to say roll the dice, they're not really gamblers, but they're going to set aside more aggressive money and play the movement in stocks like that. I don't do that personally, and I've been in the industry for over 30 years. My preference, if I decide that I want involvement more directly in what's happening out there in the genetic or the bioscience or the pharma world, what I'm going to do is trust my money to a manager, a growth manager, that might likely buy as part of their portfolio, their diversified portfolio, some of those companies. If I want to be even more specific, there are immeasurable opportunities in different mutual funds, active, passive, and the like, that will invest directly in bioscience or biotechnology funds. My personal preference would be to get that diversification. You watch Pfizer or Moderna go up 10, 15% in a day, and your mind says, God, I got to get some of that. But you could be going in on that up day and then bang, the next day you're down 20% because there was a mistake in the efficacy that they tabulated. Could be a million different things. So back to one of Andrew's key slides, diversification.
Okay. Another question from Victor. I'm learning that the market is heavily manipulated with more and more day trading techniques or day traders getting involved due to the pandemic. With this in mind, it makes it super volatile and riskier to enter a more healthy and steady market. Would you recommend day trading techniques? If so, buying options or shares?
I'll jump in on that one. So it's a good question, Victor. And again, being around the marketplace and in this role, as long as I have, I've seen people that feel really good and actually really great. I saw that back in 1998 and 1999, where people became day traders. They quit their day jobs, and all of a sudden their house was foreclosed. They stopped driving around that red Ferrari. I saw in your question here on Zoom that, entering the market with shares or with options, whenever you see the word option, think derivative and think leverage. Now, leverage can mean, magnified returns. It can also mean magnified losses. So my personal view is that trading, particularly short-term trading in and out of the market, whether it be individual securities or even in a more accentuated way with derivatives, effectively leverage, is very speculative. For people that enjoy it as a pastime, I would not make that the centerpiece of my retirement or my family wealth plan. But for people that enjoy it, if you add a little side fund there and you derive pleasure and perhaps some profit out of doing that, then so be it. Have at it and have a great time. There are people that do that, and they experience periods of success. They also experience periods of loss. But without the assuredness that I get from a broadly diversified portfolio, I would not do that with serious money. That's my personal view.
Thank you, JB. And a few that are similar here that I will answer these. What is your fee for portfolio management? And what various options or levels do you offer for portfolio management? Now, here at Patelco Financial Solutions, what we do with our advisors, we have a series of questions that we would ask you to make sure that your risk levels are appropriate. At that time, we would make a recommendation, and the fees will be very clear. We are very transparent with our fees, but they are also very different. So every solution has a different fee schedule, and your advisor would go over those with you one by one. Okay, let's see. Please compare pros and cons of owning stocks versus funds.
Andrew, you want that?
Yeah, sure. Owning stocks versus funds. So owning a fund is going to be a combination of several stocks within it. So you get the broad diversification in a mutual fund. So you're not putting all your eggs in one basket. You're not just owning Apple, for example. If you're in a growth stock, you're going to own 40 to maybe 200 different stocks. And so if you get one of those stocks wrong, you have hopefully 199 other stocks that didn't go wrong. So it's all about diversification when it comes to owning individual stocks versus mutual funds. Going back to JB's previous comments, if you want to own some individual stocks, great. Buy things that you like, buy things that interest you, but don't bet all of your money in those individual stocks. Bet money that you can lose and you can afford to lose. But most of your professional money should be in a broad diversified mutual fund instead of individual stocks from my perspective.
Yeah, one of the key things about mutual funds, it's real easy to look at this as a buy-sell type thing. Somebody sold me a mutual fund. I prefer to look at it this way. When somebody through a financial advisor or directly themselves engages a mutual fund, you're basically hiring a professional manager. Andrew's and my firm's oldest mutual fund has about 60 people that are responsible for making the decisions and managing the money. And I like to feel like I'm a pretty smart guy and I'm pretty financially savvy. I can't hold a candle with market knowledge to anything else, decision-making to the 60 people that manage that particular fund there. So I like the idea of hiring a financial professional. I think Andrew's point is well taken, and I see it applied very frequently. It does make a lot of sense to complement a portfolio, an overall portfolio with some individual securities or stocks that make sense to you, maybe even individual bonds. But I think for the core, for the safe money, I feel a lot better with professional management. One of the key advantages, if you theoretically, you buy a stock, there's no management fee for owning that stock, right? If you're sitting on Apple or Kimberly-Clark or a Procter & Gamble type stock, you don't pay every year to have that stock. If you're in a portfolio that includes that and a whole bunch of other stuff, those 60 people I referenced earlier, or any other professional manager in the industry, doesn't work for free. So it's important to shop around, to understand and recognize what you're paying for and make sure the value's there. The old adage in our industry, price is a consideration only in the absence of value. So as long as there are reasonable fees associated with what you're getting, I think it makes sense to be in portfolios.
Okay. Are 401ks still a good investment?
Go ahead, Andrew.
Yes. That's where my serious money is. That's where the advantage of the 401k is the tax advantage that you get, which is, obviously you don't pay taxes going in, you pay taxes when it comes out. So it grows tax-free. And then on top of that, some employers will give matches. So you put $1 in, they will match, or they'll give you a certain percentage what they will match up to. So I think the 401k is probably the most important to have if you have access to it.
Think back as well to one of Andrew's slides where he talked about dollar cost averaging, making kind of a set investment at specific intervals. That's exactly how a 401k works. In Andrew's and my case, every 2 weeks, I'm going into the funds that I've selected that are part of my 401k. So the 401k is not an investment. The 401k is a delivery vehicle, like an individual retirement account, an IRA. It's a basket. In that basket, there are different investments, typically mutual funds. I love the fact that I am dollar cost averaging, without my mind getting involved, because I don't even trust my mind if I let my emotions get in the way. Every 2 weeks, I'm buying the stuff that I've selected over the long term. And a little sidebar note here, go back to the global financial crisis. And I'm sure everybody on this call remembers watching a financial show, maybe reading something in a financial periodical, whatever, how the market, people lost half of their retirement savings. What they never take into account when they make these bold statements intended to keep you on the channel until the next advertisement, to keep you engaged, what they never talk about is how quickly you recover, particularly when you're consistently investing and dollar cost averaging. My 401k, and I'm 60 years old, my 401k, and this is back when I was age 50, got pounded back in the global financial crisis. It went down big. But the recovery time that I had by virtue of the dollar cost averaging was amazing. So I second what Andrew said. A 401k is a great vehicle through which we can achieve tax deferral and save more for that long-term goal, retirement.
Okay, I'm going to read 3 questions because they are all kind of interrelated.
Okay.
Do you think there are big shifts on the horizon that might make the future different to the past? Things like democratic shifts in the US or the shift to a post-carbon energy source or climate change in general? That's one question. Another one is, how relevant is historical analysis to our situation if the Democrats capture Georgia? The leadership has committed itself to dramatic changes in the US economy, single-payer government health care, the Paris Climate Program, and the Green New Deal. Expansionary fiscal policy, much higher taxes and increased government regulation. How does one invest for this future? And the other one is, how has U.S. presidential elections affected the stock market historically?
Well, there's a lot there.
Yeah, that's a good question.
They're kind of intertwined, yeah.
Maybe I'll take the first one. And I think, first of all, there's a lot of changes that are happening in the economy today and investing. And one of them is innovation. And one of the key themes that we like going forward, there's several key themes within innovation, but we feel like we're kind of in a super cycle of innovation where we are in 2020. And if you go back to the 1800s, there was kind of a similar cycle of innovation that was happening. It was all about the light bulb. It was all about the combustion engine. and it was all about electricity. Today, it's not those, but it's things like global e-commerce, the autonomous vehicle, robotic surgery. So there's a massive explosion in innovation that's investable for the very first time. So I would say, as far as green energy, EV, all these new technologies that are been around for a long time, but all of a sudden have really become normal in everybody's environment, is going to be a very good opportunity longer term. Again, don't buy one stock, maybe buy a broad, diversified approach to those, but huge innovation that's happening in the markets today. And then maybe I'll just comment on the presidential elections. You know, from our perspective, and for the 60 individuals, as JB mentioned, that are making those investment decisions, it's not about who's in the White House. It's really more about what the Federal Reserve's doing. How are the companies that we're investing, are they profitable? Where's inflation today? You know, talking about policymakers, talking about confidence in the U.S. economy. There's so much more than who's in the overall White House. And so you could look back, you know, in a chart of Democrats versus Republicans, and there really isn't a clear winner on how well the stock market does, if it's George Bush or if it's Bill Clinton or if it's Donald Trump or if it's Barack Obama. So I would say it's more important to us are the underlying fundamentals of the economy rather than who's in the White House.
Yeah, and Andrew did a pretty good job covering most of that, so I don't have to delve into that landmine arena of politics or anything. But let's stick with the technology.
Yes.
Oh yeah. Well, everybody on the call, ask yourself a question. Let's assume we all get vaccinated. There's herd immunity. We're all running around. We're shaking hands, hugs, man, woman hugs, everything. This comes up during the next year. Is anybody here on the call going to cancel their Amazon Prime account? Is anybody here going to stop having stuff delivered next day? Is anybody here going to is anybody dying to go back to the grocery store and walk through the aisles? And for guys like I am that don't even know where anything is, you know, feeling like you're lost? No. I mean, the growth in innovation is exponential. It's never linear. It's always accelerating. So to Andrew's great point, there are changes that have taken place. They were accentuated by this pandemic and this work from home environment that are not going away. That's the disruptive nature of technology. Now, I think in that question was, you know, are there some big changes we see out there? One of them would be, think about Andrew's jelly bean chart, where you had growthy stocks, you had value stocks, you had foreign stocks. For the last 13 years, the growthier stuff, you know, the Amazons, the Apples, that type of thing, have absolutely pounded the old line, cyclical, dividend-paying value stocks, utilities. We would expect a rotation. It's been difficult to get clients and even financial advisors in some cases to recognize the opportunity and value, and we see it as very underrepresented. By the same token, we see a lot of global investing underrepresented because people, you know, emotionally have been chasing the hot dot. So I do believe that diversification is going to be key, and I do believe there are great opportunities for that cyclical recovery. Basically, if you think of a stock as boring and dividend paying, that's more of a cyclical stock that's going to do better as that rotation occurs. So where do you have your exposure? To both of them. With regard to the presidential stuff going on, and there's still a little uncertainty. We're all waiting till January 5th to find out if there was an effective blue wave or not. I don't know. I think there's some real benefit. The markets like some semblance of certainty. Andrew mentioned that. And to have a divided Congress kind of puts a governor on what can happen politically. So, I mean, just from the standpoint of less volatility and extremity, I kind of hope personally that happens. But ultimately, what would it mean if the Democrats had their way? That would probably mean more spending. That would be good for the market. I heard carbon mentioned and Green New Deal. If there is if there's more opportunity, if you will, to put through the administration and Congress more spending and initiative with things that are eco-friendly and carbon taxes, things like that, I expect that will happen. You know, the horse is kind of out of the barn. I think all parties out there are interested in making the planet a better, a better place. To the question that was asked, though, if the Democrats had, unfettered access to funds and, could promote initiatives toward things like the Green New Deal, that would create investment opportunities in infrastructure type projects, and things like that are never bad. I kind of hope there's a little more balance. If you do look back in history, it's really difficult to find a period there where you can clearly state, hey, we're better off with a Republican in the White House, or a fully red lineup of politicians versus the opposite, a Democratic administration, Congress, and the like. It kind of goes back and forth, and you can point to plenty of times in a Democratic administration where the market's done really, really well. So I prefer to keep a lot of optimism. I hope for balance. I hope for a lot of interaction and a lot of constructive debate there. That's what I hope for personally, but I feel pretty good about where we're going. That was a good question,
Okay.
but a long one.
Yeah, well, it's 3 of them all together, so that's
Hey, Carolyn,
great.
I saw a question on the dialogue box that I think is important. I forgot the name. I'm not seeing it on here, but somebody asked, if I've grown my money in a retirement account for 30 years, when do I sell out of it? That's a pretty good question.
I just answered that directly.
Okay.
To
You want to
let me
share an
find
answer
it.
with everybody on that, or should we talk about it?
Sure. Yes. Well, I'm not seeing it right now, but it was, my answer to that was, it's a very individual decision.
Mhm.
So I advise that member to talk to a financial advisor, and we are going to drop a link in the chat box pretty soon about how to get to your financial advisor, your local financial advisor. I'm not finding it here. Oh, after a 30-year period, when should one pull their investment? Should that be with the advice of an advisor or one's own institution? Is that the one you were talking about?
No, I thought there was one that was talking about
Okay.
when would I sell out of all my retirement stuff if I've been in there for 30 years?
Okay.
And maybe
I'm not
that,
finding that one right now.
okay,
Mm-hmm.
no problem then.
I will look for it.
We'll move on to whatever
here's
you'd
another
like.
good one though. Yeah, let's take a few more. There's still 20 open questions, so we're not going to be able to answer them all, but we will pull them off and we will try to get back to you as well. Is it better to diversify and take more risk in your 20s with low income, or should you wait until you reach a higher income in your 40s and have more money saved up?
Don't wait.
Go ahead,
Don't
Andrew.
wait. Yeah, don't wait. The most important thing you have on your side if you're in your 20s is time, not money, it's time. So the more that you can get in at an earlier stage, the better off you'll be in the longer run, because you'll get that compounding of interest over time. So as JB talked about, dollar cost averaging, time is definitely on your side if you're in your mid-20s. Do as much as you can and you're comfortable with. And as you get more and make more and more money as life goes on, invest more and more money as life goes on.
Yeah, this also ties back into the earlier question that was a very good one about the value of advice and working with a financial advisor at any age, but let's assume we're dealing with a young person. Maybe inherits some money, makes some money, whatever, has money, sits with a financial professional and says, what do I do with this money? I'm kind of excited about, what I see out there in the stock market and technology stocks and innovation. A good, competent financial advisor like the ones that are with Patelco there, Carolyn, is going to ask that person and understand, well, what's this money for? What's it mean to you? Do you have, 6, 9, 12 months of expenses? How certain is your job? What do you want this money to be? Now, if that person, and let's say it's a 20-something-year-old, comes back and tells the financial, consultant, hey, what I really want to do is I want to be ready to buy a house in 6 months. Well, guess what? That's not going to go in a technology fund. That's got to be seen as kind of dry gunpowder So that's where navigating based on an individual's goals, objectives, time horizon, and tolerance for risk come into it. So very good question, though.
Let's take one more question. It's a couple of them together. What are your thoughts on Roth versus regular IRA? And that goes for a 401k, traditional versus Roth.
You want that, Andrew?
Go ahead.
Yeah, whenever you
CPA.
can. Yeah, whenever you can do a Roth, if it makes sense, if you're allowed to do it by virtue of income or it's available in the plan. The beauty of a Roth there is that ultimately way down the road, when you take the money out, it's tax exempt. With tax deferred plans, with IRAs, with 401ks, with basically qualified type retirement plans, it's really cool that they grow tax deferred. You can watch this big nest egg building. But when the money comes out at the time you need it and you want it, the IRS is going to come calling here. With a Roth, that does not exist. Now, what I would again encourage, and I'm advocating for financial professionals, they're armed with very good and sophisticated tools, along with experience and knowledge, but tools to help investors and clients navigate how much could we or should we conceivably convert to a Roth, or to what extent should we make use of a Roth versus just the straight tax deferred in an IRA or a 401k. So I like Roths.
Yes, I do too. I do too. Well, thank you both, Andrew and JB. This is vital information for our members. I really appreciate all of these questions. There's still over 20 questions in the queue that we did not get to that we will try to get answered. As most of you know, you can go to the next slide now, JB, thank you. As both Andrew and JB mentioned throughout the presentation, most people will need advice when investing. We have 10 financial advisors on board to help you with retirement planning, retirement income, 401k, IRA and IRA rollovers, financial planning, life insurance, long-term care, wealth transfer, and tax-free income. And we would like to share the faces of the 10 financial advisors serving you, our members. They're here to listen to your needs and help provide personalized solutions to get you on the right path. They're available to meet in person, over the phone, or by Zoom. And by the way, our financial advisors have an encrypted version of Zoom for added online protection. Also, as we discussed before, we're going to add a link in the chat box for you to be able to set up an appointment with a financial advisor near you. In addition to financial advisors, Patelco Credit Union has certified financial specialists. These specialists help with debt strategies, creating a budget, monitoring and repairing credit, and non-investment saving strategies. Actually, that was one of the questions in the Q&A is how do I start my kids if they get money for Christmas? So some of these certified financial specialists can help you with those questions as well. But feel free to schedule an appointment with a financial advisor like we had before, or any of these specialists through our online appointment tool at patelco.org/financial journey. And lastly, we truly hope that you've enjoyed today's webinar. Please check our website and join us for future webinars. And remember, wherever you are in your financial journey, Patelco is here for you. Thank you, and be safe out there. Take care.